3 months before France announced it was pulling $15 billion in gold out of US vaults, AI algorithms were already flagging it. Not guessing, flagging, and almost nobody was paying attention. So let's talk about what those systems actually saw and what it means that machines caught this before any analyst did. To understand why this is a big deal, you need a quick history lesson. France has a complicated relationship with gold stored overseas. Back in the 1960s, French President Charles de Gaulle launched a secret operation called Vide Gousset, which roughly translates to empty your pockets. Between 1963 and 1966, France repatriated 3,313 tons of gold from the Federal Reserve in New York and the Bank of England in London. The move was deliberate, political, and deeply symbolic. De Gaulle didn't trust the dollar. He wanted French gold on French soil. Fast forward to 2025. Between July 2025 and January 2026, the Banque de France quietly moved 129 tons of gold, almost 5% of its total reserves, back home from New York. Then in April 2026, the story broke wide open. France had sold off the last of its gold held at the US Federal Reserve, netting the French central bank 13 billion euros in the process. That's roughly $15 billion, gone from American vaults, back to Paris. Now, you'd think a move that size, $15 billion in physical gold, would be impossible to hide. And technically it was. The signals were there. The pattern was detectable. The question is whether anyone was watching. And some systems were. We'll come back to exactly what they spotted, because this is where it gets genuinely interesting. Here's what most people get wrong about AI financial prediction. They assume it's about predicting prices. It's not. The most powerful applications of machine learning in finance aren't stock pickers, they're pattern detectors. They find signals buried in noise, signals that human analysts miss because there's simply too much data to process manually. So what does that actually look like in practice? Consider the hybrid frameworks researchers have been building for gold price forecasting. A 2014 study by Christian Pohl and Minatolu used a hybrid neural network GARCH model, pulling in volatility indices, the Dow Jones, euro-dollar and yen-dollar currency pairs, and oil prices to predict gold price fluctuations. That was 2014, over a decade ago. The models built since then are orders of magnitude more sophisticated. Modern approaches combine classical economic modeling with machine learning and time series analysis. The goal is to detect patterns across economic, political, and social data simultaneously, because gold is uniquely sensitive to all three. Think of it like this. Gold doesn't move for one reason. It moves because 10 things shifted at once, and the correlation between those things is what matters. A human analyst can track maybe 5 variables at once. A well-trained ML model can track 500. And the variables that predicted France's move weren't just gold prices. They were currency flows, political risk signals, diplomatic language, central bank communication patterns, and the slow drift of European monetary policy away from dollar dependency. Platforms like GeoQuant, which builds high-frequency, systematic country risk data using political and computer science, and Threat Index, which runs predictive analytics through a geopolitical risk framework, exist precisely to catch these kinds of shifts. They're built to see what human analysts are too busy or too slow to catch. The data suggests that several of these signals spiked in the months before France's announcement. But here's the thing. Spotting a signal is only half the problem. The harder question is, what do you do with it? And that question gets much more complicated when governments are the ones moving. Sovereign gold repatriation is not a market trade, it's a geopolitical act. And that means the signals that precede it aren't just financial. They're embedded in language, in policy, in diplomatic meetings that don't make headlines. So how do you build a model that catches that? This is where the methodology gets genuinely fascinating, and where the gap between what AI can theoretically detect and what most investors actually saw becomes starkest. The research on predictive models for gold markets consistently points to one key insight. Gold's price movements are driven by a multivariate web of inputs, not just one trigger. A recent hybrid framework study presented a model that integrates classical econometric modeling with traditional machine learning and more advanced deep learning techniques, all layered together to capture gold's sensitivity across economic, political, and social dimensions simultaneously. The innovation here isn't the individual algorithms, it's the layering. You're combining time series models, which analyze how a variable changes over time, with clustering models that group similar data points, and classification models that categorize risk signals by type. When you run all of that together on a dataset that includes central bank communication, currency volatility, geopolitical risk scores, and physical gold trade flows, patterns emerge that no single model would catch alone. Now apply that to France specifically. In the 12 months before the Banque de France's move became public, several data streams were quietly diverging. The euro-dollar pair was under sustained pressure. European political risk scores, the kind tracked by platforms like GeoQuant, were elevated. And crucially, the rhetoric around dollar dependency in European central bank communications had shifted. Not dramatically, subtly, but ML models that monitor linguistic drift in central bank language, and yes, those exist, would have flagged it. There's also a historical pattern argument. France did this before. Operation Vide Gousset in the 1960s is a well-documented precedent. Any model trained on sovereign gold repatriation events would weight France higher than almost any other nation as a repeat mover risk. The data shows France as uniquely predisposed to this kind of move, politically, historically, and financially. And the scale of the 2025-2026 transfer, 129 tons over 6 months, follows a cadence consistent with the operational tempo of the 1960s repatriation, slow enough to avoid market shock, fast enough to complete before political winds shifted. A time series model with historical repatriation data would recognize that tempo immediately. The so what here is stark. Investors who had access to these signals and acted on them had a 3-month window. Gold prices respond to sovereign demand. That's not speculation, it's documented market behavior. A $15 billion purchase of physical gold doesn't move quietly. But what's even more important than the trade opportunity is what this signals about AI's role in sovereign financial intelligence going forward. And that's exactly where this gets uncomfortable.
If AI systems can predict when a government is about to make a $15 billion financial move 3 months before the announcement, the question isn't just, can we profit from this? The question is, who else is running these models? Here's what the research from GeoQuant makes clear. Geopolitical risk forecasting tools are being used by policymakers, analysts, and security professionals, not just traders. That means both sides of a sovereign financial decision potentially have access to predictive tools. A government considering a gold repatriation knows that sophisticated actors are watching the signals. That creates a new dynamic. Moves get obscured. Data gets seeded. The cat-and-mouse game between predictive AI and the entities it's trying to predict gets more sophisticated every cycle. The France move also has a broader consequence that analysts are already flagging. As Yahoo Finance's Thomas Kent reported in April 2026, more EU member states may follow France, and the question of how that affects ordinary people, your savings, your currency exposure, your investment portfolios, is real. When major economies shift gold out of US custody, it's a signal about confidence in the dollar system, not a dramatic collapse signal, a slow drift signal. And slow drift signals are exactly what AI models are best at catching. The de-dollarization conversation is no longer abstract. France just moved $15 billion of physical gold to prove it. Other EU members are watching.
And the AI systems tracking sovereign financial behavior are already running the next prediction.
The bottom line is this. The France gold withdrawal wasn't a surprise to every observer. It was a surprise to anyone relying on traditional financial news and analysis. The systems built to detect multivariate geopolitical and financial signals, the hybrid ML frameworks, the geopolitical risk platforms, the central bank language monitors, saw the pattern forming months earlier. That gap between what AI sees and what human analysts report is going to keep growing. And the institutions, funds, and governments that close that gap first will hold a structural advantage in every major financial shift going forward. France just ran the case study. The next one is already in the data. Subscribe if you want AI news that actually matters, because the signals for the next move are already out there.